Good morning, students. Good morning, Mrs. Moore. Um, we are going to start with our next topic, which is share capital. There's a lot that we need to discuss today. There are many questions in the question bank that we have to work through. So you've got a lot of ammunition. So don't worry. We will guide you all the way through this topic, which students find pretty challenging. I realize it, but we will see how how easy we can make the path for you. Now, hopefully, most of you, if not all of you, have already watched that narrated PowerPoint slideshow, the one that deals with the basic concepts of share capital. So many of you may already have some questions for us today. So this is going to be a fairly informal discussion. Even though I've made some notes here for myself, it's not really a slideshow, but I've made some notes so I don't forget about any topic. But what I seriously suggest, ladies and gents, is have a pen or pencil and something to write on, a notebook or some kind of stationery on hand, because I'm pretty sure you'll have to make a few notes during the course of the morning, right? As you would do in any class. Okay, so let us talk about share capital in general terms, and then we are going to become more specific. So, first of all, by the way, this is chapter 23, I think, Mrs. Moore, if I'm not mistaken. I haven't got my textbook with me now, unfortunately. But if I remember correctly, it's chapter 23.
I also don't have my textbook here now. I can go and find it and confirm that it is 23. Just give me a
Oh,
minute
no,
and then I will speak with authority. I also think it is 23, but I will not put my head on a block and swear to it. But I will check.
yeah, yeah, I'm afraid I haven't actually checked this morning either, but as I remember, it's 23. But the students will see the title of the chapter is Share Capital. Right, ladies and gents, so you can work through that chapter, but we are going to guide you through it in our various classes, whether online or face to face. So let us first talk about the two classes of share capital. Now there are at least three different standards that deal with various aspects of it. Is chapter 23. Thank you, Enrique. Mrs. Moore, Enrique has just confirmed it is chapter 23. Uh,
Thanks, Anji. I'm so busy finding it in my book, but it's good. Thank you.
yeah, then at least there's nothing wrong with our memories. That is a good sign. There's also the Companies Act, ladies and gentlemen, the Companies Act of 2008 that one has to take into account. So all of those documents, whether it be the standards or the Companies Act, they all play some sort of a role when it comes to when it comes to our classes of shares and the types of shares. We will talk all about that during the course of this morning. So let us maybe just start with our two classes of shares. First of all, we get ordinary share capital, right? Ordinary share capital, and then we have preference share capital. Now, if you encounter American textbooks, I think it's actually mentioned in your textbook. The Americans have different terms for these. They call ordinary share capital, they call common stock, and that's why we don't use the word stock for inventories anymore, for example, right? And then we've got this preference share capital, they call that preferent stock. Okay, so that's just in case you encounter any American textbook or American literature on share capital, they've got slightly different terms. Now, your ordinary share capital, or the holders of the ordinary share capital, those are the people, or it might be other entities, it might be other companies that are generally regarded as the pure owners of this company, right? You remember from financial accounting one, we had a sole trader where one person is the owner of the company. We had a partnership where certain natural persons, certain individuals come together and they run a business together, and they own the business together. A company is a more structured way of combining capital and combining various owners uh, in an ordered and structured manner. That is why there is a Companies Act in South Africa and most other countries will have some sort of a Companies Act. They might call it slightly differently, but it will be an act that governs their corporate structures. So your ordinary share capital, or the holders of the ordinary share capital, we can simply call them the ordinary share capital holders. They are the pure owners of the company. Then the company can issue a different class of shares, which we refer to as preference share capital. Preference share capital. Now, the question that will probably come up initially in your minds, what is meant by preference share capital? Now, preference means you are in front of somebody else, right? So you are being treated with some sort of preference. So if you have a little queue that you are in, you are in front of the queue, if you know what I'm trying to say. So when it comes to preference and preference share capital, what preference do those shareholders have? And here you might have to just take a few notes. It basically comes down to two aspects. First of all, if the company should be liquidated. Now, I know this is not, we're not talking law here, but these terms we just need to know what they mean. If a natural person goes bankrupt, right? If a natural person goes bankrupt and that person owes anybody money, then they will sequestrate that person, right? That person will be sequestrated, which means that most of that person's assets will be sold at an auction, and the proceeds of the assets at the auction will go towards paying the creditors. There are certain basic things that the assets that they cannot sell. They cannot sell your bed, for instance. That is an essential item, but they can sell anything that is regarded as non-essential. A company is in a similar situation. If a company is bankrupt, in other words, it cannot carry on trading, then the company will be liquidated. When the company is liquidated, a similar process happens. The company's assets would be sold. It will normally be sold off at an auction, and then the proceeds of that auction will be used to pay off the debts of the company. Now, when it comes to the debts of a company or a natural person for that matter, there is a certain pecking order. There's a certain pecking order. The first kind of creditor that needs to be paid is what we refer to as secured creditors. Secured creditors. A secured creditor would be where that creditor uh, as a specific asset of this company that the company used to secure the loan. So let's say it's a mortgage bond loan, for instance, right? A mortgage bond loan on a building. So in order for this company to obtain that building or to obtain that mortgage bond loan, the financing company would have required it to use the building itself as the security. So whatever the proceeds of that building is, that loan will be paid off first. And then we get something called preference creditors. Now, don't confuse that with preference shareholders. Those are two very different things. So now we are now just talking about preference creditors. So it's a category of creditor that is just behind in that queue of getting paid if a company is liquidated, is just behind the secured creditors. For instance, one example there is the South African Revenue Service. So once the secured creditors have been paid, then the preference creditors will be paid. And if there is still money left, ladies and gentlemen, then your concurrent creditors will be paid. So they are third in line, right? So once the secured creditors have been paid, the preference creditors have been paid, then they pay all the concurrent creditors, right? So that is all the other creditors. Then, ladies and gentlemen, at the back of the queue, there we find the shareholders, right? So if there is still money left, then the shareholders will get some of their investment money back. But even there at the back of the queue, there's a little pecking order, and that is where the preference shareholders they are standing in front of the ordinary shareholders. So the preference shareholders will get their money first, and only if there is any money left after that will the ordinary shareholders get their money. So that is the one aspect where preference shareholders comes in and where preference share capital comes in. When it comes to the repayment of capital, if a company is being liquidated, they get their money before the ordinary shareholders can claim any money. There's also a second aspect where they get preference, and that is when it comes to dividends. So when dividends are declared, and we're going to talk quite a bit about dividends a little bit later today as well. When it comes to dividends, before the ordinary shareholders can get their dividend, the preference dividend holders, their dividend must be up to date. So, for instance, if the company wants to declare a dividend to the ordinary shareholders this year, they must also declare a preference dividend. So they're not allowed to to uh, uh, to only the ordinary dividend because the preference dividend has preference, right? So the preference shareholders are again just in front of the queue when it comes to the declaration of dividends. While we're on the topic of dividends, this is also a good time to take a note, ladies and gentlemen. We'll talk about various kinds or types of preference shares in a few minutes, as you can see there. This is just a good time to maybe make a note. When it comes to preference dividends, it is usually expressed as a percentage. A percentage, we call that the dividend rate, a percentage of the capital invested. In other words, the value of the money that has been invested by those preference shareholders, right? So a percentage of the value of the money. When it comes to ordinary dividends, it works a little bit differently. There, the dividend is declared in rands or cents or dollars or pence or whatever currency, let's call it just rands at this stage, rands or cents per share. What does that mean if I say a certain amount, rands or cents per share? Is that on the value? Now you can type something for me in the chat, ladies and gentlemen. Would that then be calculated on the value of the investment or the number of shares in issue? You can just type for me either value or number. Number. Thank you. There, you've all got it. Thank you. Enrique was quickest again, but we've got a lot of answers there, and you're all correct, right? So when it comes to your ordinary dividend, please remember it is expressed as rands or cents per share. So you're going to calculate whatever rand or cents per share was declared multiplied by the number of shares in issue. Whereas in the case of preference share capital, you'll apply the percentage, the dividend rate to the value of the shares. Right, so those are the two classes of share capital that we find, ordinary share capital and preference share capital. Then in the case of preference share capital, ladies and gentlemen, we can get very specific or special types of preference share capital. And the type will be determined when the shares are issued, not after issue. So when the shares are issued, those preference shares, this will already be determined. Mrs. Moore can help me out here. There might be more than three special types, but I could only come up with three this yesterday morning. Cumulative, redeemable, and participating. So let us talk about all three of them. When it comes to cumulative preference share capital, right? And perhaps even before we start discussing that, if at the date of issue of the shares, it is not specified that it is cumulative, or it is not specified that it is redeemable, or it is not specified that it is participating, then it means it is not. So the default is usually not. Right? So it has to be specifically mentioned at the date of issue, whether it's cumulative or redeemable or participating or any two or even all three of them. Right? So when it comes to cumulative, preference share capital, ladies and gentlemen, what that means is that the dividends for those shareholders, those preference shareholders, it accumulates. The dividends accumulate every year. So even in a year that a preference dividend is not declared, that dividend actually accrues to the preference shareholder, right? So, ladies and gentlemen, if it's non-cumulative, is non-cumulative preference share capital, then it means for any year, any financial year, when a preference dividend has not been declared, those preference shareholders forfeit the dividend. They cannot go back and say, we still want last year's or the year before's dividend. Why haven't you declared it? But if it is cumulative in nature, then those dividends would have accrued. Now I'm going to ask you to type a few things for us, ladies and gentlemen. Let us picture a few scenarios here. Let's say this preference share capital is not cumulative. We refer to that as non-cumulative, actually. But anyway, let's say it's not cumulative in nature. And then let's say in year one, the company did not declare any dividends. And in year two, the company did not declare any dividends. And then in year three, the company now has sufficient cash. Now they want to declare an ordinary dividend. Now, as we've said earlier, the preference shareholders get preference over the ordinary shareholders when it comes to dividends. So in year three, where there were no dividends declared in year one, no dividends declared in year two, now that we are in year three and they want to declare an ordinary dividend, for which year or years must they also declare the preference dividend for? If you can type for me, year or years. Well, I actually want the number. Year. Sorry, I should have said for year one. Year. Lucille, that's the answer I was looking for.
I was just going to say,
Thanks.
there are a few who are already spot on.
Yeah, they come. Yeah, they come. Lucille and Lucanio there. Michle, okay, Nelisiwe. Right, thank you, ladies and gents. You get the idea. So I should have mentioned I wanted a figure. I'm sorry about that. There we go. Afiwe, year three only. Right, Mr. Henriks gave himself 100%, all the other students as well. Okay, that got it right. Okay, so they only then need to declare the preference dividend for year three. Now, ladies and gentlemen, let us now picture a different scenario. Let's say these preference shares are cumulative in nature, right? So they are cumulative in nature. And then let's use the same scenario. In year number one, no dividend was declared. In year number two, no dividend was declared. Then when we get to year number three, where the company might have a better cash flow, they want to declare an ordinary dividend. When they are going to declare that ordinary dividend, we know that the preference shareholders get preference. It means that the preference shareholders' dividend must also be declared, right? In this case, where it's cumulative in nature, for which year, and I want a number this time, or numbers, for which year or years? Thank you, Sibongile. Thank you, Lucanio.
They are all
Thank
on
you.
the ball.
Yes. No, wow. I am impressed. Thank you, Mrs. Moore. No, I agree. There we go. 1, 2, and 3, or all 3 years, as Enrique says. Thank you, Pokelo. It's page 1113 or something, if I remember correctly. But it's chapter 23, Pokelo. It's chapter 23. I think it's about page 1100 and something. I don't know why 113 is 117. Thank you, Enrique. That helps. So, okay, this time my memory wasn't quite so good. So page 1117. Okay, so in that case, ladies and gentlemen, where it's cumulative in nature, because the dividend for them has accrued in the year one and it has accrued for them in year two, it means they don't ever forfeit the dividend. So when the company is in a position sometime in the future when it can declare a dividend, it must bring all those cumulative preference dividends up to date. Right. I think that is now, I think everybody gets that because of those answers. Right. So now let us look at the next one, redeemable. Redeemable. What does it mean if the preference shares are redeemable? It means, ladies and gentlemen, and again, this will be determined at the date of the issue of the shares. So right up front, there's no mysteries, there's nothing hidden. This is totally, what's the word they always say, transparent, right? So the shareholders know what they're in for, the company knows what it's in for. So this is determined up front. So if it is redeemable, it means right up front, they are saying that at some point in time in the future, we intend to buy these shares back. So eventually, and we'll get to the eventually, which is very vague now, but we'll talk about that more specifically in a moment or so. So initially they say, we need this capital for this company to grow, or for this company to expand, or even for this company to just get established. But we don't, thank you, but no thank you. We don't want you as shareholders forever and ever. We only want our ordinary shareholders forever and ever. So at some point in time in the future, we are going to pay you back your money. You would have earned some dividends in the meantime. Very nice. We're going to pay you back your money, but we don't want you as shareholders after that. Right. Now that sometime in the future can be determined in many ways. We'll talk about that, especially when we are going to do the questions, when we are going to do the various exercises. So they can determine a specific date already. So if they are issuing these shares, let's say on the 2nd of January 2023, they can determine and say the redemption or the payback of the money for those investments in the shares will take place, let's say, on the 31st of December 2028, for instance, right? That has some implications that we are not going to deal with in financial accounting too, because in a situation like that, it actually means that your preference share capital should be seen as a liability. It should be accounted for as a non-current liability. I'm just mentioning that scenario, but now we are not going to talk about further this year in financial accounting too, because we are only going to treat or discuss the situation where your preference share capital is seen as equity. So in that kind of scenario where the data has been fixed, it should actually be treated as non-current liabilities. Then we have got other possibilities, ladies and gentlemen, where the data has not been fixed, Then the two possibilities that might come from that scenario is that it can either, the date of the redemption can either be determined by the shareholders. In other words, they can vote for it at an annual general meeting or a special meeting. So it can be determined by the shareholders, or, ladies and gentlemen, it can be determined by the company. So if the company's directors, if the company has got the power to determine when the shares will be redeemed, then it is quite possible that those shares will never be redeemed. The company may decide never to redeem the shares. So in that scenario, it really must be treated as equity. It now really is truly equity. It is share capital. However, if the shareholders at a general meeting can vote and say, end of December this year, we want our money back, that means the company cannot decide when it is going to be redeemed. It is out of their hands. The shareholders can decide that at any point in time. And again, in that case, your preference share capital should actually be treated as a non-current liability. Again, we're just mentioning that fact, ladies and gentlemen. We are not going to deal with that where any of our preference share capital is treated as a non-current liability, because that has all sort of ramifications. You only deal with that in general financial reporting form. So for our purposes, our preference share capital will always be seen as equity. So it will always, the decision to whether to redeem it or not will always, in our case, lie with the company. Okay, right. Now let us look at participating. Participating. Now, I'm almost going to contradict myself to a certain degree now. As we've said earlier, the preference share capital preference shareholders dividend is calculated as a percentage of the value of the investment. But uh, the type of preference share is a participating preference share, it means over and above their normal preference dividend, which is calculated by applying that dividend rate to the capital that is being invested. Over and above that, they also share to a certain extent in the ordinary dividend. Now, again, this sounds a little bit Greek probably, and my apologies to any Greeks out there. But I think it'll become clearer when we work through some of those exercises as the weeks carry on, right? We are going to spend more or less about 4 weeks on this topic. So if it's participating, then it means they also, over and above their normal preference dividend, also share to some extent or some degree in the ordinary dividend. So they will also get a few cents per share. So not only do they get the percentage, they also get a few cents or rands per share, like the ordinary shareholders. Let us just pause there for a second, ladies and gentlemen. Are there any questions?
Seems like they're all good, Mr. Van Rensburg.
All good.
Oh,
Thank you,
sorry.
Mrs. Wood. Thank you, students. So now let us go and look at how can your share capital change. Now scroll down too far. How can your share capital change? Now share capital can change in a variety of ways. Let me just see. I heard something there.
There's a question, yes.
Can you please repeat the participating? No problem, Jody. When it comes to your preference shares, if at the date of issue they say that these are participating preference shares, it means that over and above their ordinary dividend, they not ordinary, their normal, I should say, their normal preference dividend, which is calculated as a percentage of the capital invested, over and above that normal preference dividend, they also get a certain rands or cents per share, like the ordinary shareholders, right? So they, in other words, participate in the ordinary dividend as well. I must admit, I haven't come across many of these situations in my practical life, but it is definitely a possibility. You're welcome, Jody. Okay, so how many ways can share capital change? Well, many ways, but I've listed the most common ways here. It might even be all the ways. I'm not even sure, but I think it's it's definitely all the ones I could think of. First of all, the issue of shares. So when shares are issued, ladies and gentlemen, it can be ordinary shares, it can be a specific type of preference shares or various types of preference shares. It means that investors, either private individual or institutional investors, other legal entities, other companies, banks, for instance, uh, uh, insurance companies, and so forth. It means they take up your shares, and in return, normally, we'll talk about one exception later, for money. So they provide you money like any other owner. What does the owner of a sole trader do? First of all, before he or she can start trading, they must provide capital to that business so that the business can purchase, let's say, office equipment and cash registers and inventory to sell, right? So it needs money. So, how does a company get their money? How does a company obtain their money? They issue shares. And those shareholders are then the owners of the company, especially the ordinary shareholders, the pure owners, right? So that is how the company initially gets its capital. That is why it's called share capital, right? And many people share in the capital, or many institutions share in it. That's why it's called share capital, right? Okay, so the issue of shares. Another way in which your share capital can change is if the company buys back some of the ordinary shares. We'll talk about a few scenarios later on when we do our exercises. Why would this happen? This would normally be where the company feels that its share price, especially listed companies, its share price is trading too low because there are too many shares on the market. It's embarrassing to them. Then they might start buying back some of those ordinary shares so that there are fewer shares in the market, which means that the share price of the shares will actually go up. I'm going to use this little this little circle later on. I call it my company chocolate cake. So later on, when we talk about share splits and share consolidations, we're going to get to this little graph here again. But if you imagine your company to be a chocolate cake, right? The company is a chocolate cake. So the more shares there are in circulation, or let's put it in the case of the chocolate cake, the more slices of this chocolate cake that you slice, the smaller each slice is. Isn't that so? Because that chocolate cake has got a fixed size. It's not going to become bigger or smaller because the company is like the chocolate cake. At that point in time, it has a certain size. So the more slices you cut, the smaller each slice will be. The fewer slices you cut, the bigger each slice will be. I hope I'm one of those that get the big slice. But anyway, so the whole point is here, if they buy back some of their shares, fewer shares are in the market, which means that each share will have a higher market price. We'll also talk about the matter of treasury shares. The Companies Act actually changed fairly, not the Companies Act, the standard IFRS 32, I think it is, or I'm not even sure now, changed recently. So now they call it the shares that have been bought back. They say that you must account for it as so-called treasury shares, but we will discuss all of that when we get to the exercises. Sibongile, you've got a hand up. Yes. Sibongile?
So is there a way in which they determine which shares they're gonna buy back? Or do they just pick a random share owner, ordinary share capital owner?
What will normally happen in a case like that, Sibongile, is that they will do it proportionally. They will do it proportionally. So uh, let's say they are going to buy back. Um, let's just use simple figures. Let's say they are going to buy back 2 shares for every 10 shares in issue, right? 2 shares for every 10 shares in issue, right? That's what they're going to buy back. And let's say that there are a million shares in issue, right? So there's a million shares in issue. Now, perhaps some of the students can type for us there. That means if they're going to buy back 2 shares out of every 10 shares, and there are 1 million shares in issue, How many shares are they going to buy back? In total. I'm not answering your question yet. I realize that. I'm working my way there. There are 1 million in issue. 200,000. Thank you, Lucanio. There we go. Thank you, Enrique. Now we've got a lot of answers there. Thank you, Mr. Malay. Right. So that means they are going to buy back 200,000 of those 1 million in issue. Does that make sense so far? Now, when we get to your question, actually, for each individual shareholder, they're going to buy it back proportionately from them. So let's say I, as a shareholder, right? I, as a shareholder, I own, let's again use simple figures. Let's say I own 1,000 shares. I own 1,000 shares. How many shares are they going to buy back from me as an individual investor? Someone can type to us. 200. Thank you, Lucanio. You are super quick this morning. Thank you, Asive. Thank you. Okay, thank you, Kolani. 200. So they're going to buy back 200 of my 1,000 shares, right? So now let's say a different person owns 10,000 shares, right? A different person owns 10,000 shares. How many shares are they going to buy back from that person? You can type for me again. 2,000. There we go. 2,000. Thank you all. You are very awake. Thank you. Thank you, everyone. Lucanio and Asiya and Sibongile. Right. So I hope that answers. Yeah, that is, I mean, that's really thinking out of the box. I must
So
admit.
the principle for those who are not following is that you have to divide by 10 and multiply by 2.
Thank you, Mrs. Moore. Yes, Enrique, you deserve that applause there, definitely. Thank you, Mrs. Moore. That is really the formula. So, because this will always occur in a proportionate way, so that one shareholder is not disadvantaged as opposed to any other shareholder. This normally happens in a proportional manner, right? So, the more shares you have, the more shares they will buy back from you, but it will be in that ratio. As Mrs. Moore has said, whatever number of shares you own, the number that will be bought back will be that number of shares that you own. Like Mrs. Moore said, multiplied by 2/10, 2/10 in other words, or 1/5 if you wish. Does that answer your question? I think you've basically answered it yourself. Yes, Sibongile.
So if I'm hearing correctly, they're not like eliminating people, they're just eliminating the amount of shares that each person has.
Exactly. So they're not getting rid of any shareholders per se. You're 100% correct, Simengile. So they are decreasing the number of shares that is available on the market. And this, like I said, normally happens with listed companies who want to increase their listed share price, right? So they decrease the number of shares in circulation, but the same shareholders will still remain after the process, and they will all still have the same ratio of shares in their ownership, right? So the ratio of ownership will remain the same, the shareholders will remain the same, but there will be fewer shares itself in issue after the process. Happy, Sibongile? Perfect. But that was an extremely well thought out question. I have to say, I haven't thought about that in a long time, and I didn't expect that actually. But that was a very good question, and I guess that is now something that everybody will remember in the future. Later on, when we are going to look at special kinds of share issues such as rights issues and capitalization issues. We're getting ahead of ourselves. We'll talk about that later on. Then we'll look at proportions again, proportions and ratios. Quickly, it's not quite like a share split. No, we'll talk about a share split in a few minutes. That is part of our little agenda there. And then Enrique, unless you decide to say, yeah, obviously you can always sell your shares, right? You can always sell your shares to another investor. Okay, maybe I should just expand on that. What Enrique says there is quite correct. There's nothing that prevents you as a shareholder from selling your shares to any other investor, to another person or another company who wants to buy your shares. So that is normal share trading. A share buyback is not where you sell your shares to another person. This is now where the company withdraws those shares from the market, right? So the company itself will repay you your investment, right? The company will, well, that's why they call it a buyback. The company buys those shares back from you. So they withdraw those shares from the market. Those shares are no longer in issue. A company may reissue them in the future if necessary, but we'll see that when we are going to talk about treasury shares. There are 2 or 3 of those exercises that deal with that. So the company will then call those shares that have been withdrawn from the market, they'll call it and they'll account for it as treasury shares. There'll even be a separate column in your statement of changes in equity then called treasury shares, right? But the company is allowed to reissue them at a later stage. Quickly, a share split. We're going to talk about that soon, so don't worry. We will address that, but it's not the same as a buyback. A buyback actually affects your share price. Well, a share split as well, but a buyback actually means that you are withdrawing shares without issuing further shares. When it's a share split, it's a different matter. You are withdrawing shares, yes, but at the same time, you are also issuing shares. But like I say, we'll talk about that soon. Then the other possibility, we've talked about that, if it's redeemable preference shares, when they buy those preference shares back, it is also a buyback, but in the case of preference shares, we refer to that as a redemption. So a redemption of preference shares is exactly the same as a buyback of ordinary shares. But because the various standards refer to the term redemption in the case of preference shares, that is why we use the term as well. Right. Now let's talk about share splits. This will excite Kuhle. A share split, ladies and gentlemen, is very, like Kuhle mentioned, there is very similar to a buyback, but it's also quite different. And we'll talk about the similarities and the differences now. When it comes to a share split, this is where the company feels, whoa, our shares are not trading sufficiently. Our shares almost never trade simply because they are too expensive. Our shares are trading at 500 rands a share on the JSE or on the NYSE or the LSE, whichever exchange. But nobody can afford to buy, not ordinary individuals can afford to buy 100 of them. And unfortunately, when it comes to trading on the securities exchange, you cannot go and buy 1 share. The minimum number of shares you can go and buy is 100. So if your shares are trading at 500 rands a share, and you or any individual wants to buy some of those shares, they must at least pay how much? 500 times 100. That's 50,000 rands, right? So you cannot invest in that company share at less than spending 15,000 rands on it. So if a company feels that their share price is so high that it inhibits or limits the tradability of those shares, then they may decide to do a share split. So what happens, ladies and gentlemen, they might have let's say a 10-for-1 or a 5-for-1 or a 3-for-1 share split. And now I'm going to go back to our chocolate cake again. And they are going to just simply divide the shares into smaller pieces. So if we go to our chocolate cake, let us just do that. Let's again imagine this chocolate cake is our company. I just want to go to some shapes. Just want to pick a straight line there. So let's say, for instance, this company has got only 4 shares in issue. So, right, they've got 4 shares in issue. Actually, now I've moved the whole thing. I'm the world's worst artist, ladies and gentlemen. I'm you simply have to live with this. Okay, so let's say this company only has 4 shares in issue, right? It means that each shareholder basically their equity is 1/4 of that company. So it means those shares will be extremely valuable and extremely expensive. So what they do in the case of a share split, they simply split those shares into smaller pieces. So they take this chocolate cake and they cut it up into more pieces, right? More pieces, but each piece will now be smaller than the original pieces. Right, so now we've got 8 shares, right? But the chocolate cake is still the same. So we've got 8 shares instead of 4 shares, but with the chocolate cake being the same size, it means each slice is now smaller than the original slice. That was the original slice. Now your slice, each slice is half of the original slice, right? So what that really comes down to, let me just go to the home again. So what that really means, ladies and gentlemen, is that when they do a share split, let's say in that case it was just a 2-for-1 share split, but it can be a 5-for-1 or a 10-for-1 share split. It means they take back those original big shares, but at the same time they issue with you as a shareholder with many more shares, right? So if you as a shareholder had 1 share, in our example with that chocolate cake, if you as a shareholder had 1 share, they take back that share and they issue you with 2 new shares. But each of those shares will now only be half the value of the original share. So if they had been trading at 500 rands per share on the JSE, now they should be trading at 250 rands per share, right? Because the slice of the cake is smaller. Yes, Kusle, a share buyback is more like a share consolidation, except again, the only difference really is that in the case of a share buyback, you withdraw the shares and you return the money to the shareholders, right? So perhaps we can just be clear on this. In the case of a share buyback, you take the shares back from the shareholders, you withdraw them, and you return their money to them. In the case of a share consolidation, what do? You also withdraw the shares from the market, you withdraw it from the shareholders, but you do not return their money, you give them new shares, but those shares will now be fewer. So if it's let's say a 10-to-1 consolidation, if a shareholder owned 100 shares, you will withdraw the 100 shares and you'll issue them with 10 shares. But now each of those shares will be worth 10 times more than the original shares. Does that make sense? I hope so. So, Kusli, you're quite right there. That would be in the case share consolidation, where again, just like with a share buyback, where you feel that your share price is too low, it might be embarrassing to you. You want to basically increase your share price. How can you do that as a company? You make sure that there are fewer shares in circulation. And because there are fewer shares in circulation, it means each share is now worth more. In our case, if we only had originally, let's say 8 pieces of the cake, now we take back those pieces, we put them together, we put two slices together, and we return those 2 slices to each shareholder. It means each shareholder now only has half the number of shares, but those shares are twice as valuable. And exactly, Kusle, that is such a good point. That is why I'm using that chocolate cake. The market capitalization, the market cap stays the same. The whole cake, the company chocolate cake, or the size of the company does not change. It is only the structure of your share capital that changes. So the market cap stays the same. Market cap being market capitalization, students, right? So the size, the market cap is really the size of our chocolate cake, right? That stays the same. So clearly, ladies and gentlemen, what we can see from that is that when there is a share buyback, you will have to journalize it, right? There will be transactions because you are withdrawing shares from the market, but you are returning money to the shareholders. So you'll have to credit your bank account and you'll have to debit. We'll see later on what we are going to debit. It will be called treasury shares, right? So you are cancelling that, but you are returning the money. In the case of a share split or a share consolidation, no money is returned to the shareholders. You are just exchanging shares. In the case of a consolidation, you are taking back many shares and you are giving them less shares, but each share is worth more. In the case of a share split, you are taking back some of those shares, but you are returning shares in kind, but only there are now many more shares that you are returning to your investors, but now they are worth less per share. The market capitalization stays exactly the same. So in the case of a share consolidation or a share split, you do not even have a journal entry. It does not affect your statement of financial position or your statement of changes in equity. What it does, however, affect, ladies and gentlemen, later on when we are going to do the exercises, we are going to talk about that. It does affect your share capital notes. So later on, not today, not this week, later on, when we do the exercises, we are going to create a share capital or more than one share capital note, a share capital note for our ordinary share capital and share capital notes for each of our types of preference shares. And there we indicate the number of shares in issue, not the value, because the values of the shares are indicated in the statement of changes in equity. We're not going to repeat the same information in the note. In the note, no, that's new information. There we are going to disclose the numbers of shares in issue that were issued during the year or bought back during the year or redeemed during the year. Right, so good point there, quickly. Thank you very much for that. Anything else? Any other comments or questions, ladies and gents? So I don't even have to talk about share consolidations anymore. They are just the opposite of a share split, right? So just the opposite. So here you are taking back many small shares, but you are returning to the same shareholders also shares, but they are now worth more, right? Worth more, but fewer shares. Let me just see if there are no comments, no further questions. Thank you for all those questions. All of them were very, very thought provoking. Mrs. Moore will agree that was very, very. I don't want to use the word surprising because we expect you to be thinking out of the box, because
Well,
that
they were very good
comes up
questions, well thought out.
well thought out and thought provoking. Thank you, Mrs. Moore, for helping me out there. Very well thought out and obviously thought provoking to myself and Mrs. Moore and all the other students. That's what we want from an informal discussion or debate like this. So thank you for that participation. We highly appreciate it. Now, just a few basic entries, ladies and gentlemen. I didn't want to go into too much details about the entries, because when we start doing those exercises, we are going to do every conceivable sort of entry, right? But just as an initial thought, how do we actually issue shares and how is it accounted for? Now, before I actually, well, I'm already showing you two typical transactions, but there's actually a whole process There's a whole process, and this doesn't happen in a day. It doesn't happen overnight. It also depends on the type of issue. We'll talk about many types of issues a little bit later today. It also depends on the type of issue, how long it takes for the issue to take place. But let's look at a typical kind of issue which we refer to as a public offering. A public offering. Only public companies are allowed to do a public offering, by the way. We will discuss that at some point as well. So if it's a public offering, then the company would create a prospectus. They will send out a prospectus to potential shareholders, people or institutions or financial institutions or banks that they want them to become shareholders in this company. So they'll send prospecti out. They might even put an advertisement in the financial papers where they invite members of the public. Like I said, this is now a public offering, and only public companies are allowed to do a public offering. So they invite members of the public to subscribe to the shares, right? So what you will then do, you will complete that coupon, or you will do it electronically. You'll do a funds transfer to this company. And then, ladies and gentlemen, you might find that there's a situation of an oversubscription. There are more people or more institutions interested in taking up the shares than the shares you are going to issue. Then you have to actually go and allocate it again proportionally. We've spoken about proportionally later on. So if I apply for 1,000 shares, and this proposed issue is 100% oversubscribed, it means I'm only going to get half of the shares I applied for, right? Pokelo, when it's a share consolidation or a share split, you do not debit or credit any account, right? Because you are not paying back the money. So if it's only a share consolidation or only a share split, you are just changing the quantity of shares that's out there in the market. You're not paying back the money. So it's only when it's a redemption or a share buyback that you will have journal entries, right? That it will affect your cash payments journal. So it doesn't affect any accounts, Pukilo. So it doesn't affect any accounts. A share split or a share consolidation does not affect any general ledger account. It only affects your share capital note. Yellow, why? Because the cake hasn't changed. The cake is still the same. You haven't paid any money out of the cake. You didn't get any money in. You just changed certain shares for other kinds of shares. But it does not affect the company's ledgers. It doesn't affect the company's statement of financial position. It only affects your share capital note. In other words, it only affects the composition of your share capital, right? It doesn't
Can we
affect.
just put in some numbers there, Mr. Van Rensburg, just maybe to make it easy for them, easy numbers to work with. The total capital hasn't changed. All you've done is you've changed the value of each share. So let's say they had 100,000 share capital consisting of 100,000 shares of R1 each issue price, right? So 100,000 shares were issued at R1 each, giving you a share capital of 100,000 Rand. In the case of a share split, let's say that each share was split in half. Your share capital is still 100,000 Rand, but the shareholder now holds, instead of holding 100,000 shares at R1 each, the shareholder now holds, or shareholders now hold in total 200,000 shares at 50 cents each. Does that make sense? Students?
It makes sense.
Initially, there were 100,000 shares at R1 each to give you a share capital of 100,000 Rand. Now you have a share split. So each share is split into two shares. So you have 200,000 shares at 50 cents each, still giving you a share capital of 100,000 Rand. Yes, only the share price changes and the number of shares in issue.
Exactly.
Right?
So,
So
Mrs.
share
Moore,
consolidation would be exactly the opposite. You would consolidate any number of shares. I'm just working with two because it's easy for me to work out in my head. But you could have split into any number of shares. My brain might have then just had difficulty, but yes, that is the issue. So, Mr. van Rensburg, taking the same issue further, do a consolidation for them quickly. 100,000 shares, let's say we consolidate 2 shares into one. So it means instead of the share having a price of 1 Rand each, it will now have a price of 2 Rand each. So 100,000 Rand split into shares of 2 Rand each would give you 50,000 shares in issue. 50,000 shares in issue times 2 Rand per share gives you that same share capital of 100,000 Rand. Those are very simplistic examples, but it illustrates the point of why no ledger accounts are involved at all. Your total share capital amount stays the same, so your share capital account can't change. As Mr. van Rensburg says, you will just issue new shares to the shareholder. The shares are now no longer worth 1 Rand each. They're worth either 50 cents each in the event of a share split, or they are worth 2 Rand each in the event of a share consolidation.
thank you,
I hope
Mrs.
that
Moore.
I've helped and not confused you more.
No, I think that definitely helps. That is one of my shortcomings. I probably do not use examples enough. So that is a very good example using actual figures to illustrate exactly a share split and a share consolidation. Thank you, Mrs. Moore. That was necessary and that was perfect. So as you now can realize, there, students, the only two things that change is the number of shares in issue and then the share price of each individual share. So it doesn't affect the company as such, it only affects the shares. So you've got to see the shares separate from the company in this case, right? I hope that makes sense. So what changes is the number of shares. If it's a consolidation, there will be fewer shares in issue, but they will be worth more. Each share will be worth more. If it's a share split, there will now be more shares in issue after the share split, but each share will be worth less. But in total, like Mrs. Moore has illustrated in her example, the total value of the share capital, not the shares, now we're talking about the share capital, still remains 100,000 rands. Whether it's now 200,000 shares of 50 cents each, or whether it is now 50,000 shares of 2 rands each, the fact is your total share capital still comes to 100,000 rands in Mrs. Moore's example. Are you guys happy with that?
I'm sure they should be. So maybe you
Yes.
can move on.
Thank you. Okay, super. Thank you. Thank you all. Thank you, Mrs. Moore, and thank you, students. Right. So where were we? So when there's a oh, we were still with the process. That's where we were. So ladies and gentlemen, that takes a long while. So it might even be a case where the issue has been oversubscribed. Better now. Thank you so much, there, Pokelo. Perfect. I appreciate that, and I'm glad that it is clearer now. That is the important thing. My happiness doesn't count. Your happiness counts. Okay. Um, so anyway, it's a long process, but for our purposes, the end result is what matters. So when we issue shares for money, we are simply going to ignore the whole process that where we've received millions more, but we have to return some money to the subscribers. We're going to ignore that. We're just going to look at the end result. So what is the end result? The end result is that we would have issued shares and we received money for it. So that simply means, ladies and gentlemen, for the money that we have received in our bank account, we have to debit our bank account. And for the shares that we've issued, we've got to go and credit, depending on the class of shares, either our ordinary share capital account or our preference share capital account, right? So those are the two legs of the entries, that will be required in the case of the issue of shares. We'll see later on there is a very specific kind of share issue called a capitalization issue, and we'll talk about that when we get to it. In that case, the shareholders actually get shares for free, the existing shareholders, right? Again, in proportion. Let us not forget the in proportion, in the same ratio as they already own. They will get free shares, right? And in that case, ladies and gentlemen, it is almost similar to a dividend, a non-monetary dividend that is being declared. So in that case, you cannot debit bank because you haven't received money, but you have to debit something. And because it is similar to a dividend, you are giving them part of the retained earnings. You are rewarding your shareholders by giving them more shares. It comes out of your retained earnings. So therefore, you will debit retained earnings in the case of a capitalization issue, and that's the only case. And again, there are actually shares being issued. It does affect your share capital account, so you will credit either your ordinary share capital account or your preference share capital account, depending on the class of shares being issued on a bonus share basis. Okay, may we proceed? Everyone happy? Can we walk off? Can we step off from that little topic? Okay, but we will. Perfect. Thank you, Lucanio. Thank you, Nalisiwe. Thank you, everyone, and Eswa. Okay. Anyway, like I say, we are just giving you the background today. We will give that. That is why we wanted to start with an online class, so everybody gets exactly the same background. And then, as usual, we are going to apply it in practical exercises that will illustrate all these points even better. But we have to understand where all of this comes from, right? Then, ladies and gentlemen, the ways in which shares may be issued, there are a number of ways in which shares may be issued. This is not actually mentioned in your textbook, so it's this is just for general knowledge, almost, if I can put it that way. For me, it's important to know, or for me, it's important for you to know, because eventually, when you are out there practicing as an accountant, you will, in all probability, encounter these terms. So when shares are issued, your normal 99% of the time, I can almost say, it will be for money. It will be for money. Now, when your issue is for money, there are three possibilities. There might be more, but I thought about it and I thought about it, and those were the only three I could come up with. So I believe those are the only ways. The one is, let's maybe start with the second one, a public offering, because we've addressed that a little bit earlier. So a public offering can only be done by a public company, right? So they can now advertise, and they can invite members of the public. They can invite anybody, in fact, to come and take up shares in the company, right? That we refer to as a public offering. So we are offering our shares to the general public out there. Anyone who is interested in taking up the share issue, in taking up shares in this company, they are welcome, right? Then we get private placements, ladies and gentlemen. Now, any kind of company can do a private placement. A private company can do it. A public company can do it. Even a personal liability company can do it. And even a state-owned company. And those are the only four types of profit companies in any case. So any kind of company can do a private placement. What happens there? Your shares are not offered to the general public, ladies and gentlemen. You only offer your share to specific parties, right? So you're not going to place an ad in the paper. You are only going to approach selected, let's say, institutions that you want to be associated with. So you might go and approach Investec, or you might go and approach Old Mutual, or you might go and approach Cosmopolitan, or whoever, and you say, this is my prospectus. I intend to issue 1 million shares at 5 rands each, or whatever the case may be. We invite you as a company or you as a person to invest in our shares, right? So that is a private placement. Does it also lead to dilution to existing shareholders quickly? Yes. Yes. If you issue more shares, it will lead to a dilution in shares, definitely. But once again, it only affects the shares, the share price. It doesn't affect the capitalization or the cake, the size of the cake, right? They might now have more money available, which they certainly will have. They will have more shares in issue, but that money will be used to expand the company, to make that chocolate cake bigger, right? To perhaps take over the business of another company, or to merge with another company, or to buy more plant and machinery, or to establish a new plant. So it will be used to expand the company. So eventually it will also benefit the other shareholders, because now the cake will become bigger. The cake will become bigger. It will take a bit of time, but the cake will become bigger, right? Because of the additional investment. Then we've got a rights issue, ladies and gentlemen, a rights issue. A rights issue is where the company is going to issue shares, and I'm going to preempt your question, Kuchle. In the case of a rights issue, before you even ask it, this will not dilute your existing shareholding. It might lead to a decrease in the value of each individual share, but from the perspective of from the perspective of each individual shareholder, it will not dilute their shareholding, and you'll see why just now. So in the case of a rights issue, ladies and gentlemen, the company is going to issue more shares, but they are only going to offer the new shares to their existing shareholders, right? So nobody who is not who is not already a shareholder can take up the shares. It's not transferable. That right is not transferable, right? That right only belongs to the current shareholders. So what the company will then say is, right, we want to issue shares to the value of 10 million rands, but we are only offering it to our existing shareholders. In proportion, here we get back to that little term that we spoke about earlier, and thanks again for that question. I forget now, but anyway, so it will be offered to them in proportion to their existing shareholding. So when we are doing those exercises and we get to rights issues, we'll illustrate that practically to you, right? The shareholders do not need to take it up. They can say, no, we're not interested in taking up any more shares. Then the company is allowed to offer those shares to other shareholders who are interested, right? But initially they must offer it to the existing shareholders in proportion to their existing shareholding. Okay, so I'm going to follow Mrs. Moore's example. Let me put figures to it. Let's say, for instance, they are going to offer 1 share to the existing shareholders for every 10 shares that the existing shareholder already owns, right? So we're offering 1 new share that they must pay for, obviously, that they can take up if they want, for every 10 shares that they already own. Let's say I, as an individual shareholder, I own 100 shares. How many new shares will they offer me to take up? If you can type for me. 10, exactly. Thank you, Mr. Malay. 10 shares. Thank you, Lisa Kanya. There we go. Right, so 10 shares. So in proportion. Now, let's say I, as an individual shareholder, I own 1,000 shares, right? I own 1,000 shares. How many shares will the company offer me to take up? 100 shares. There we go. Christopher. Mr. Mallow, thank you. There we go. Thank you, Lucanio. Right. So there, excuse me. So again, that will be issued, the rights issue, thank you, Pukelo. So it will be issued, it will be offered in proportion to the existing shareholding. And that is why I said to Kuthle a little bit earlier, you can see that it will, the individual shares might become less valuable, but the total value of the shareholding for each shareholder will stay exactly the same because the size of the chocolate cake has not changed. um,
I'm not sure what the Ys are for, Mr. van Rensburg.
I was thinking the same thing now. Can either Mbuyelo or Pukelu, if you can just maybe ask us why what?
Is it Y 100?
Why 100? Okay, because they
I'm not
are
sure.
offering. Yeah, I'm not sure either, but so if they are offering one new share. Yes, the 100. Ah, thank you. Thank you, Naomi. No, thank you, Mbuyelo. So why 100? Because they are offering one new share for every 10 that I already own. Again, Mrs. Moore can maybe help us out here. She's wonderful with formulas. There, Mrs. Moore, we are reading each other's mind here. Thank
Yeah.
you, Lucille. Yeah, there
Every
we go.
bundle of 10, for every bundle of 10 that the shareholder holds, he is being awarded one bonus share. So divide by whatever bundle has to be made up and then multiply by the number of shares being allocated for that bundle. So you would have achieved the same result if you said times 1/10, but in principle or reasoning, I prefer to make up the bundle by dividing by 10 or 20 or whatever, and then multiplying by the number of free shares allocated for that bundle. So if we said that you're going to get 2 shares for every bundle of 8, or 2 shares for every bundle of 7, we would have taken the 1,000 divided by 7 and then multiplied by 2. Do you get the idea?
I think they do. Thank you, Mrs. Moore. Mbuyela also says they're cool, thanks, and Pukilo as well. And there's a nice little red heart for us. Right. Thank you so much, ladies and gents. Thank you, Mrs. Moore. So there you get the idea. There's the formula. So if they are offering one for every 10-year-old, then you simply apply that formula. So if I, as an individual, hold 100 shares, they'll offer me 10. If I, as an individual, own 1,000,000 shares, they'll offer me an additional 100,000, for instance, right? So you can simply apply that formula to your existing shareholding, the number of shares you already own. Okay, can we proceed, ladies and gents? Oh, my word, I cannot believe the time. Anyway, I don't mind us going slowly because then at least everyone is on this. Ah, for Mrs. Killian, I of
Oh, wow. Thank you very much. I'm so happy to be receiving some love.
I thought as much, but I just said thank you on her behalf. But now Mrs. Moore said it herself in any case. So the important thing is that we cover this thoroughly and that you understand the concept. So even
And
if we
you
have to
covered
carry
most
on
of
a
the
little
most
bit,
important ones, Mr. van Rensburg, because that's what I was worried about. In class, we have to
yes,
start with some exercises, and you've covered most of the concepts that they need, because unfortunately there are no easy exercises. The very first exercises are involving redemption already, which is going to be difficult to do if they don't even know how to record a share issue, but you've covered that.
yeah.
So I'm going to send you an example which I'm going to do in class with my students tomorrow, and which you can also do with your students. It's basically the same content as the questions, it's just presented a lot simpler. So
Thank you,
I'm
Mrs.
going to
Moore.
send it to
Okay.
you to upload onto Blackboard so that they have it on their phones or on their computers tomorrow when they come to class.
Okay, and then we'll make sure that all the offerings and all the campuses has that same exercise. Thank you very much, Mrs. Moore. That will certainly help.
Sorry, Mr.
Just
Van Rensburg, there's one question. Can I just answer that question for Nande quickly? No, Nande. Group H's class is not on a Friday. It has been moved at very early in last term already to a Thursday. Group H's class is on a Thursday, I think at 9:15. Just confirm with somebody else in the class, or I will put it in the chat box for you soon. Right now, I'll just confirm. Mr. Van Rensburg, sorry for the interruption. You can
no, you are most welcome. That question had to be answered. Thank you. Feni, we'll talk about that soon, how to convert authorized shares with par to non-par value. We're not going to actually talk about how to convert it. We can talk about how to convert it, but clearly we won't have time today because our time is basically up, isn't it, Mrs. Moore? I think your next class is at 15:15, if I'm not mistaken, and I want to give you a little break. So I'm just going to talk about this not for money, and then Mrs. Moore, can I next week just talk about par value and non-par value shares and capital maintenance clauses? It won't take more than maybe 7 or 8 minutes. Okay, so then just when it comes to not for money.
Sorry, I didn't realize I
Sorry.
had muted my mic when I was checking the timetable. Certainly, you can take 5 minutes or so next period, next week, because unfortunately the question is also quite long. So we need to devote most of the 1.5 hours to doing the question. Otherwise, that we might not get done with it. But certainly you can take as many minutes as you need.
Yeah, I just basically just want to tell him there's a story about par value versus non-par value shares and then capital maintenance, and then I'm done. So 5 minutes is probably ample. So I, I hope to have it done, but unfortunately we're not going to quite finish it. Okay, just the last little matter, ladies and gents, about capitalized issue not for money. A capitalization issue, we've already mentioned that earlier. That is where the company wants to reward their shareholders. They want to reward them with a dividend, but they haven't got sufficient cash. So they're cash strapped. Their cash flow is a problem at the moment. So an alternative way in which they can then reward their shareholders if they haven't got sufficient money is to give them free shares. We refer to that sometimes as fully paid up shares or bonus shares, but the process is a capitalization issue, right? Capitalization issue, so the company provides those shares for free instead of a dividend, and that is where we need to debit retained earnings and credit the share capital account, right? We'll come back to many of those in our exercises as well, but I just wanted to point out that is the one exception where an issue does not take place in exchange for money. But obviously, those shareholders now own more shares because they received free shares, and because they got more shares, the next time the company can issue a cash dividend when the cash flow situation has been sorted out and they can actually declare a dividend, it means those shareholders will now get dividends on more shares. They own more. So that eventually the cash effect thereof will come to their benefit. It will flow through. Okay, those last two issues, par value and non-par value, I'll just address very briefly, maybe 4 or 5 minutes, and capital maintenance, and then I'm done with this part. Students, thank you very much for attending so well again. I did notice there were more than 200 students in total. Thank you for attending. You have to be off to your next class. We'll speak soon. So anyone who doesn't have a question, you are welcome to leave. If you have a question, Mrs. Moore and myself are here, but we don't want to impose on your time for the next class. We don't want to make enemies of our comrades.
I've also also posted a notice there that the class for GNH is on a Thursday at 9:15 in room C2.52 for the person who asked earlier on.
Thank you, Mrs. Moore. Perfect. Thank you, students. So if you've got no questions, you're welcome to